Hello YouTube, today I'll be discussing how to pick a good stock based off of fundamentals, so stay tuned. Welcome back to the Contrarian Investor YouTube channel. My name's Logan. I like to talk about investing, success, having your money make money for you. Today I'll be discussing how to pick good stocks based off of fundamentals, and this is really a building point off of my previous video of what stocks to avoid to begin with, and just characteristics of companies you don't want to really even touch. But this is more going into detail of, companies that you probably have selected based off of good reasons, and now we're going to look into more detail at those companies as to whether they're a good investment or not. So there's two steps you need to go through. There's picking the companies you want to buy, and then there's finding the right price you will buy them at, regardless of the current price. So there's a few things you need to keep in mind here. You have to be picky, and you can't get attached to a certain company. You also need to pretend that you're trying to find an entire company to buy. So pretend you're like one of the sharks on Shark Tank. You're going to be asking a lot of questions to yourself about these companies. I really don't understand people who just buy a stock, really not based off of much information. You're buying a portion of a company, so you really want to view it as that. And also for all of this, you can basically find all this information on Yahoo Finance and Google. So that's the two main areas where you can find it. It's very easy to find all this information. So first of all, I want you to picture that you're a doctor. Fundamentals are like the vital signs on a patient. So they indicate what strengths and weaknesses a given company have. And a doctor is going to pay close attention to different signs based on a patient. So fundamentals will vary from industry to industry. You're really going to have to focus on different companies within an industry. Just to focus on what is a good deal and what is not a good deal, because fundamentals will vary significantly from industry to industry. A good example of this would be airlines would be considered very risky compared with other industries. Like the PE ratio on airlines is usually going to be a lot higher than on other industries. And this is just because airlines are very dependent on fuel cost. And car manufacturers are the same way. So like Ford and General Motors stock and Tesla stock for sure is going to be a lot more risky than other industries you might examine. And on the contrary, Google would be a very safe stock considering fundamentals. It has a very high asset to debt ratio or asset to liability ratio. So it'd be considered a very safe stock. But that's in the whole kind of tech sector or industry. So you're going to really have to focus on companies within an industry and comparing companies within like industries. So the first step is finding companies to buy. So you're going to want to look at several measurements here. First measurement to look at is rate of return on shareholder equity. And this is going to be a percentage, or it's going to show up as a decimal. But it's basically the earnings divided by the total shareholder equity. You can also calculate this by the earnings per share divided by the shareholder equity per share. It's going to yield the same result. Value investors like me like to look for 12% or 0.12 or higher. 0.2 or 20% or higher would be a great measurement for this company to have. You also want to look for a consistent uptrend in earnings. Now, this will definitely vary from year to year, but you want to pick companies that either have very cyclical and predictable earnings or that have consistent uptrend with their earnings. So you're not going to want to pick a company that has a consistent downtrend in earnings regardless of how the market as a whole is doing. So, if over the last 10 years it's trending down in earnings, you'd probably want to avoid that company. It's just not a growing business anymore. On the contrary, if you find a company that has been beaten down recently but has good other fundamentals, and it's only been beaten down because of larger macro, economic trends, then this could, be an exception. You'd want to look more into that. Another fundamental to look at very heavily is the PE ratio. This is just the price of the stock divided by the earnings per share, or total market cap divided by the total earnings. They would yield the same result. Basically, This is a measurement of how expensive a stock or company is, and you want this number to be as low as possible. So the higher the PE ratio, picture that as a more expensive stock. So if you look within an industry, say car manufacturers, you'd want to pick the car manufacturer with the lowest PE ratio generally. There's obviously exceptions with that, and you want to look at other fundamentals as well, but this is a really key fundamental to look at. Say you want to compare PE ratios within an industry and pick generally the company with the lowest average PE ratio over the last several years. Another thing you want to ask yourself is, can the earnings quickly pay down the debt? And this is a fundamental that Warren Buffett really likes to look at. I like to look at it as well as a value investor. Essentially, you want to pick companies where earnings could pay off debt within roughly 5 years. So that would mean that earnings are greater than or equal to around 20% of debt. And you can find all this information again on Yahoo Finance or on Google, whichever one you prefer. But essentially, this is going to show you could the company pay down their debt very quickly. If not, then you'd probably want to avoid this company. Again, it varies industry to industry, but basically paying down debt quickly is a good sign of a healthy company, that it's not going to be affected heavily by interest rates. If interest rates are to rise, this doesn't mean that they would go bankrupt. It would mean that they could probably still stay alive and still thrive during that time. So this is another fundamental to look at. Another fundamental I like to look at as a value investor is the price to book value. And this is commonly, a less looked at fundamental, but as a value investor, I really like to examine it. So it's essentially the stockholder equity divided by the total outstanding shares. And this would also be the assets minus the liabilities divided by the total outstanding shares. So it gives the perspective on what the actual value of a company would be if it were all liquidated. Now, this is obviously, not likely for a company to do while you're owning it. Hopefully it doesn't happen that it has to liquidate everything, but it just gives the book value of what the company would be if it were examined in that way. So it's also an important thing to keep in mind. It's one of the reasons why I probably would not look into any of the FANG companies right now, just because their price to book value is much, much lower than their current share price. I'm not saying that these are bad companies or anything. I just think that both with the index funds and also the kind of the growth that's been behind them recently, it's just probably mispriced their shares slightly higher than what I think is justified, and that's basically why I would personally not invest in them right now. Examples of companies that do have a good price to book value are beaten down retail right now. That's an area that I'm invested in actually right now, is beaten down retail stocks, but they do hold promising, returns for the future, and that do have quality businesses. So that's just something to keep in mind as well, is that price to book value is a good measurement of kind of what the market's pricing in, and it can show you possible mispricings in the market that you can take advantage of. And then the last fundamental that I like to look at is the enterprise value. So this is essentially asking, could the company buy itself? And again, this is also pretty unlikely to happen, but it's a good thing to pay attention to. So enterprise value equals the current market cap plus the total debt. And so if the company were to buy itself, this would essentially mean that the company would have to purchase back all of their shares and pay off all of their debt. So in order to do this, they would have to take out a loan for both of those combined. And so if their operating income is greater than, say, a 7% interest on the total loan that they would have to take out, then they could buy themselves. And this would generally be a good sign, a good stable position to be in. So that's another thing I like to look at. Again, this would depend on interest rates, but generally I like to use a conservative estimate of 7% interest. Even though they're at historical lows right now, I kind of like to price in what is kind of the worst possible interest. So basically, if you think a company is overvalued based on the above indicators, you're going to want to wait until it falls to the price or market cap at which it could buy itself. Also, you want to wait for macro market indicators to be good. So, as a good example right now, probably a really good example in the last 10 years would be what's happening right now with the, macroeconomic, indicators currently going on with COVID and the really high volatility we've had. I would just personally not buy in because everyone's really buying right now, and the stock market is really pricing in a perfect recovery from the shutdown and everything that's currently going on. As Warren Buffett said, you want to be greedy when others are fearful, but when they're greedy, you want to be fearful. So right now, the picture is really not an ideal situation to get into. I would personally, try to avoid buying into any companies right now. At least wait, another 3 to 6 months, I would say. Just see what happens. Yeah, but you're going to want to enter at an ideal time, and you're not going to be able to predict the bottom of a bear market or the top of a bull market, but you're definitely, want to get in at, a good area and, sell at a good area. But it's not hard to really realize that people are probably being a bit foolish right now with their investments, so I would personally just stay out of it right now. Anyway, I hope you guys enjoyed this video. If you like it, give it a thumbs up. If you didn't like it, give it a thumbs down and let me know in the comments why you think I could improve on it. And yeah, I hope to see you again.